Hello everybody, welcome into the NinjaTrader Ecosystem webinar room. Before we get started with the presentation, I'd like to take a moment to test for picture and sound. So if you can see the slideshow, and if you can hear my voice, can you please type the letter Y into the room, and this will confirm that you can hear my voice and you can see the screen. Alright, thanks everybody. It looks like I'm coming in loud and clear. Thanks for the confirmation. Thank you all for joining us today in the webinar. My name is Ryan Lai. I work with the NinjaTrader Business Development Team here in our Denver, Colorado office. We have a very special event for you today with Justin Weinraub of Trader and Markets. Before we move any forward, I'd like to ask everybody in the room to participate in a quick poll. And the question is, are you currently using NinjaTrader? I'll start the poll here and allow you to answer the question. And while you answer that question, it'll give me the opportunity to read over a disclosure as well. I'd like to mention to everybody that it is important to understand that there are substantial risks in trading commodity futures contracts, and you should carefully consider whether such trading is going to be suitable for you, and this will depend on your specific circumstances and financial resources. It is possible to lose all of the funds that you deposit with your broker, and you can even incur losses beyond these amounts. If you have questions, you can always inquire to ninjatraderecosystem.com/risk disclosure. I'm posting that in the room, and you can read the full entire CFTC risk disclosure there. Also, please remember that these training webinars are not a solicitation or a recommendation for any services. They're simply educational in nature. And this presentation is being presented by the NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. If you have brokerage-related questions, you should direct them to the brokerage directly, and you can email to brokerage@ninjatrader.com, or you can call the number 312-262-1289. And it looks like most people had a chance to fill out the poll. So in the lead here, we currently have people who are currently not yet using NinjaTrader in the lead. So it's great to see people interested in the platform joining these events for third-party vendors. If you haven't downloaded NinjaTrader, you can get a free copy at the link that I'm posting in the room. For those of you who are interested in purchasing or leasing NinjaTrader, you can take a look at our purchase options at the following link. Alright, so with that being said, we're very excited for this unique event today in which Justin Weinraub will teach you the 2 out of 3 method for increasing your trading edge. You'll learn how to quantify the quality of a trade's edge in real time. This will allow a trader to better trust their decision-making process and trade with more confidence. So thank you again for your attendance in the webinar today. And without further adu, it is my pleasure to welcome into the NinjaTrader webinar room Justin Weinraub. Go ahead and take it away, Justin.
In terms of an overview today, I want to first of all say thank you to NinjaTrader. I really appreciate the opportunity to speak with you today, and I'm a big fan of NinjaTrader, so thank you for that. I want to tell you a little bit about me. I've been trading since about 2000. The first 7 or 8 years were a disaster. I blew out 4 or 5 accounts. It might have been 6, but it's just kind of the same old story where I would have great hopes, get into the market, do okay sometimes, but ultimately end up losing my money. Typically didn't take more than 6 months, and it was a pretty rough period, but I knew that I wanted to do this. Fortunately, around 2007-8 or so, I found a mentor who taught me some things that I had never thought about before. It helped me see the market a way I'd never seen it before, and thought about myself as a trader the way I'd never thought about that before. That really helped me turn the corner, and since that time, he and I partnered up. Turns out that my background and his background were good matches. He has since retired, but I really do enjoy teaching. I like talking trading. I think that teaching and talking trading and doing this day after day and working with people has actually made me a exponentially better trader as well. So that's just a little bit about me. There's more on the site. I can certainly talk more about that as well. But to get started here, I want to talk about, this is a really big thing that it took me like I said, a lot of years to learn this, but when I finally kind of learned it and made sense of it, helped me turn the corner. And I'm pretty sure that if you feel like you're very close to being successful, or if you're very close to being very successful, there's a pretty good chance that you're making this mistake. But before we talk about, let me talk about how most traders tend to approach the market. And this was certainly my pattern. There are other patterns, but this was certainly my pattern. I would go on this quest for this perfect setup, this entry where I could have, I'd go back and look at good setups and try to apply rules to them and back test, and I would just put in hours and hours and hours and hours at night doing this. I would feel like I had a great system ready to go. I'd put it in use at the market, and lo and behold, it just didn't quite hold up as well as I hoped. And so then I'd go back to the drawing board, or I'd lose my money, and basically repeated that pain. Another way you can do that is sometimes people are, you're fortunate enough to find setups that actually work, but you find sometimes it works, sometimes it doesn't. It's kind of confusing. Why did it work that time? Why didn't it? And you realize if you could just kind of eliminate a good percentage of those bad trades, that you'd be in really good shape. Others, kind of go the guru route where they think they can go into some guy's trading room and he's promised them the world, and all they have to do is follow along, and lo and behold, somehow it just doesn't quite work out as well as he told you it would. I mean, we've all kind of been down that road. But the bottom line here is that most of us, and this makes sense, it applies to, it makes sense with how our brains are wired. We tend to be focused on our entry setup. In other words, we're trying to find a rule-based way of getting into the market. If rule X happens, and then rule Y happens, and then this oscillator turns over, and this indicator is green, and whatever the case may be, then you're going to have a trade setup, and we're taught be disciplined, take the trade, and it's all going to work out. And the problem is it usually doesn't. I have found very, very few traders where it actually works that way. Certainly didn't for me, because there's a reason for this, obviously, and that it's that different conditions require different strategies. Okay. This is intuitive. It makes sense if you're driving, okay? You can look at the picture on the right, and you know that you better not go 85 miles an hour around that icy curve there in the mountains when it's snowing, whereas you could easily go 85 miles an hour. You could go a lot faster than that on the picture on the left and actually be safe, right? So the different conditions require different strategies, and that's the same with trading. I don't want to get too in-depth with this, but basically the market's always in a quest for balance, and it's in balance where I call this a horizontal phase where, the participants, buyers and sellers, essentially agree on fair price, and then something happens and the market goes vertical or imbalanced, and then it finds balance again. And what happens is if you are a trend-based trader or a momentum-based trader, well, that works great when the market's in a vertical condition, okay? But you get your head chopped off when it's not in a vertical condition. Or if you're more of a fade trader, reversal type trader, works great when the market's balanced or horizontal. But thing starts to trend and break out, you're in a lot of trouble. And so what happens is if you don't understand the condition that the market's in, your trade setup, is not going to work. Your trade setup has to fit the condition of the market, in other words, okay? So the solution here is I always talk about this, context first. Make sense of the market's story. The market's always telling us a story if we know how to read it. And if we can make sense of that context first, make sense of the story the market's telling us, then and only then do we want to apply an entry. Okay, so let's say that you have a long entry setup that comes in. If the market's context or the story matches that trade entry, it makes sense to take that trade. If it does not, then you don't want to take that setup. And if you're not sure, you don't want to take that setup. That really does an amazing job of knocking out the, there's nothing you can do that's more powerful to a P&L than avoid bad trades. This helps you stay out of really bad trades. So if you kind of compare the two models here, the two common traits of traders, and I know we've all gone through this, but most unsuccessful traders, you learn a trade setup or you come up with a trade setup, it appears, you take it, and you know what, if the market context is in alignment with your trade, it's going to work. You're going to feel good. You're going to be happy. But if the market context is not in alignment with your trade, you're going to be confused. Why didn't it work? What's going on? We compare that to more, the vast majority of successful traders in this day trading field. What they do is what I teach is you try to make sense of the market story, make sense of the market's context first. And if it is in alignment, you can take that trade with confidence. It doesn't mean they're all going to work out. I don't want to imply that because they're not. But there's no such thing as a 95% success rate. But what you're doing is you're giving your chance of success so much a greater percentage when you actually are in alignment with the condition of the market. And so, like I was saying, high probability, low risk trade setups, they do exist. But if you just take them blindly with no context, you're going to be in trouble. If, on the other hand, like I said, you and I harp on this all the time, it's always about making sense of the market story, making sense of the context first, then you apply your trade setups. So the good news about this is that if you can learn to read the market's context, it's a skill. Any time there's a skill, it can be learned. Okay, this is not like playing in the NBA. You don't have to be 6'7" with amazing athletic ability. This is a skill that any of us are capable of learning. And once you learn that skill, it's going to pay off time and time through the rest of your career. So, if logically speaking, we agree that context first is very important, the next, logical question would be, how do you go about putting the market into context? How do you make sense of the market? How do you know when buyers are in control or when sellers are in control? How do you know if it's likely to be a trend day or if it's likely to be more of a consolidation? And that's where I want to talk about this idea of 2 out of 3, okay? And the idea here with 2 out of 3, and I'll dive into a lot of detail about each of these components here in a moment, but the idea of 2 out of 3 is that we're trying to look at 3 main points of evidence, okay? And the more of these evidence points that come to the same conclusion or point us in the same direction, the better our edge. And just so you know, these are the 3 that I use. A lot of our clients, bring other pieces of evidence to the table. The key here is that there's no single holy grail piece of evidence. There's no indicator that, on its own is going to give you, incredibly high probability situations. What you want to do is you want to look at the evidence you have and kind of mix it in your mixing bowl and see what comes up. And that's the idea here. In other words, the more pieces of evidence that line up, the better. For example, if you have 1 out of 3 pieces of evidence, I equate that to riding a unicycle, right? I mean, you can do it, and when you pull it off, it looks neat, just like when someone rides a unicycle, or the guy that, at our mall, there's a guy that rides a unicycle and juggles like swords that are on fire. I mean, it looks really great when you do it, but I'll tell you, there's a lot of danger that's involved with that. It takes a lot of practice, and so it's not for the faint of heart. But you can do it. It's a risky trade, right? Whereas if you have 2 out of 3 evidence, you have a good edge. You have a safer trade. I equate that to riding a bicycle on 2 wheels. Of course, there's still some danger anytime you're riding a bike. It's not a 100% success rate. You can wipe out, but you have a pretty stable base and a pretty safe type of a trade. And then you have a 3 out of 3 evidence points. Again, there's never a guarantee, but it's the highest edge, safest trade that you can take. And it's like riding a 3-wheeled bike. I mean, you can still crash. There's still danger. You're not always going to win on a trade, to kind of take this analogy into the trading realm, but you're a lot more stable than even if you have 2 wheels, right? And so that's the analogy I like to think of with the 2 out of 3. And so the 3 evidence points that I look at are, number 1, today's market behavior. What's going on right now under the surface of the market, and I do that by looking at a combination of what I call aggression bars and then box theory, and I'll talk in detail about that shortly. I also look at, on the intermediate term level, what I call using zone logic, and I'll talk about that, and then we also have a bigger picture bias, which is longer term information. So I want to start just briefly with the big picture bias. Essentially what that is the path of least resistance in the long term, okay? And this is something that we know heading into the day. We have that posted in the markets and we in our site, I should say. And we know heading into the day what the big picture bias is and the scenario that would change that big picture bias. And basically, ideally, I mean, it's the path of least resistance longer term. So ideally, we would rather trade in that direction if we can. It doesn't mean we can't go against the big picture bias. It just means that if we're going to trade against the big picture bias, we need to make sure there's enough shorter term evidence to support that, okay? In other words, the burden of proof is less if you're trading with the big picture bias than if you're trading against it, okay? So hopefully that makes sense. Don't need to go into too much detail about that. That should make sense. Now, the second part is what I call zone evidence, and this is basically an intermediate term behavior of the market. And again, these are defined before the day begins, so we know what these are prior to the day starting. And this is just kind of a different take on, if you're familiar with support and resistance or supply and demand zones or things like that, this is a little bit different take on that. I found it to be very effective. But basically what we're trying to do is we're defining these zones of expected support, resistance, or containment, and we want to see how the market reacts within and around these zones, because that's going to give us, number 1, good location, and number 2, good information about the relative strength or weakness of the market on a given day. So, for example, let me just give you one very simple scenario. Let's just say that we open we're within a zone. It's basically containment. What we would expect is if the market came down to the low of the box, we would expect support. But if sellers are strong enough to break through the low of that zone, that's a bearish development. That's giving us evidence that these bears are pretty strong. Conversely, if we start in containment and we go up toward the high of the zone, we would expect resistance. However, if buyers are strong enough to break above there, that is a bullish development. It's giving us evidence about the relative strength of the market, okay, on the intermediate term. Here's a different scenario. I don't want to go into too much detail here, but if we are coming from above down to a zone, we would expect the high of that zone to offer support, okay? And that's our expectation. If, however, the sellers are able to get down into that zone, that's a bearish development. It shows that the bears are stronger than we would have expected. That's giving us information. Same thing if we're coming from below and going up to a zone, the low of that zone we would expect to offer us resistance. I mistyped there, it should be resistance. And if we get up and through there, then we would say that's a bullish development, and our expectation would be that we would go to the high of that zone. So again, we go into a lot of detail in teaching this, but that's the basic concept. These zones are giving us ideas of where we would expect support, expect resistance, and if something changes where the market is showing us more strength or less or more weakness than we would have expected, that's giving us a good piece of information, okay? Now, is big picture bias alone enough to trade on? No. Is the zone evidence alone enough to trade on? No. It's just one piece of the puzzle, okay? But when you combine it with the, big picture bias, when you combine it with the, today's structure, which I'll talk about, then you really have something to work with. You've got a strong scenario where you can make a lot more sense of what's going on. You're not dependent on one piece, one indicator. You're trying to put different levels of market context together to make sense of the story, okay? So let me talk. We talked about the big picture. We talked about the zone. The third piece of evidence in the 2 out of 3 idea here is what I call the now evidence or today's evidence, okay? This is, to me, where it gets really exciting and interesting because one of to me, the most important skill, as I mentioned at the beginning of being a good day trader, is being able to read the market, okay? And the way that I do that and the way that I teach that, and there's been really great feedback on this, is through a combination of what I call aggression bars and this idea of box theory, okay? So you can think about this, if you think about a trading day as a book, the aggression bars are basically the pages of the book, and boxes are the chapters of the book, okay? So if we kind of go with that analogy here for a second. So let's talk about the pages of the book first, these aggression bars. And this is how you can see in real time what is moving the market. And so the idea here is that the market is only going to move when one side, either the buyers or the sellers, is collectively more aggressive than the other side, okay? Call this buying aggression or selling aggression, okay? Now there's a misconception, a lot of people you'll hear talk about this or on the news, that, hey, the market went up because there were more buyers than sellers, or it went down because there were more sellers than buyers. That's not completely accurate, okay? By definition, anytime, a contract or a share of stock or whatever it is traded, there's a buy side and a sell side. There's the same number of contracts being bought to sold, or else a transaction couldn't occur. So it's not that there are more buyers or more sellers. It's that collectively one side is more aggressive, okay? So if the market collectively, all the buyers and sellers, the buyers are more aggressive at any given point, the market's going to move higher, and vice versa, it's going to move lower if the sellers are more aggressive, okay? And so the idea here is that if aggression causes price to move, and that's why price moves, there has to be, in other words, if everyone was just sitting around waiting for the other side and everyone was passive, the market wouldn't move. It would be stuck in mud, right? So aggression is what moves the market. It's what causes price to move. So therefore, it stands to reason that if you can identify and see aggression as it's happening, you're going to be able to read the market more clearly. That's going to lead to better trading decisions, and better trading decisions lead to better results. There's no, secret, holy grail, magical indicator there, but if you can consistently see the market better, you can make better decisions. Better decisions consistently lead to good results, okay? So it's nothing amazing. And so what these relative aggression bars are doing, what they're showing you, we have 3 levels of them, okay? They're looking at what's going on under the surface of the market. They're telling us, number one, which side, either buyers or sellers, is more aggressive at any given moment in time, whatever time frame you want to use. And then most importantly, they're telling us the degree or the level of the buying or selling aggression. So we have moderate buying and selling aggression, strong buying and selling aggression, and then extreme buying and selling aggression. And the level 1s are interesting. We really want to focus on the level 2s and level 3s. That's what's telling us. When we see that, that means something important is happening in the market, and how the market reacts to these aggression bars gives us a lot of information, okay? Think about this as, these aggression bars are real time. They're not a lagging technical indicator. They're not just price action. You can think about the image there on the left as, we're looking down on a highway, right? And that's We can see if we're looking down on it, cars are going north, cars are going south, cars are speeding up, slowing down, turning right, turning left, whatever the case may be. That's the equivalent of a price action chart. I mean, you can see what's happening. But it would be a lot nicer if we could actually see kind of under the surface so that we could get down at car level and see, okay, when is the driver hitting the accelerator? Now, is the accelerator being pushed to the floor, or is it gently, is the car gently accelerating? Or conversely, we have a deceleration as well that I'm not going to talk about today, but that's like the brake pedal. And is the brake pedal being slammed, or is the brake pedal being gently applied? So if we can kind of see what causes the car to go north, south, east, west, fast, slow, we have a lot better ability to see what's going on in real time than if we're just looking at what happened, or what happened over the last 21 bars, or whatever the case may be. So we're trying to get under the surface of the market real time, because aggression is what leads price. And if we can get a better handle on where price is likely to go, it gives us certainly an advantage. So the possibilities are pretty endless with the aggression bar tool. We have a lot of people that use them in a lot of different ways. I'm going to talk about the box method in a second, but before I do, let me just give you a couple brief examples. Basically, these aggression bars are telling you when something important or worth paying attention is happening versus when there's just noise. You can see in this chart, we've got some decent buying, and then the market just goes sideways. There's level ones and gray bars, and it's not until we start to see level 2 or level 3, action come in that we know we need to kind of pay attention. Okay. Another way that these really help you is help you avoid being on the wrong side of the market. A lot of that's with the box theory I'll talk about in a minute as well. But you could see early in the day here, sellers are in control. It's our first sign of buying, and then buyers take over. You can kind of see that with the bars as it's happening. Okay. It can be a very big help on determining a true breakout versus a head fake. If this is our low of the day early on, we take it out by a couple ticks, but it's not on good aggression versus later in the day we break out on really extreme selling aggression, and that shows us that the breakout is a lot more likely to occur. And so if I see there's some questions, we'll get there at the end. Let's see here. Another way that you can look at this is if you have a predefined area of interest, support, resistance, in which we do, it's telling you, okay, we're expecting, let's say, support at a given area. We can then wait and kind of zero in on that area when the price gets there and see if aggression is actually coming into the market. Okay, so there's a question from Lou. Can't you see this by watching price? No, the whole point is that you're actually getting under the surface of price, right? You're getting under the surface, and you're able to see that. You're able to see not just if the market's going up or down, but what's behind it. Is there strong aggression behind it, or is it just kind of the natural give and take of the market? Okay, that's the big difference there. Also another use of these aggression bars is to help you stay into a trade a little bit longer. I know, a weakness that a lot of people have is getting out of trades a little bit too early. And this is the type of situation where, let's say you're in a trade from that point there, the question is, okay, how long do I want to stay in that trade? And you really ideally want to stay in the trade until you see the other side coming in. And so here, in this middle part, you can see it's going back and forth, back and forth. It's really difficult for, we've all been there to kind of sit through 20, 30, 40 minutes of a trade just kind of going back and forth. But it's a lot easier to sit through there if you can see that the other side's not coming in, or that there hasn't been a failure of any buying. And so in this example, you can kind of sit through that time and just wait for, proof that the other side is coming in. Okay. And it's just, again, takes a lot of stress off of you when you can actually just kind of wait for the evidence to develop and look for that. So again, just a small sampling of some of the ways aggression bars can be used. The main way that I teach them is as a kind of component. Like I said, if you think of the day as a book, trading day as a book, the aggression bars are kind of the pages of the book. They're telling us what's important, what we need to pay attention to, and they form these things called boxes in what I teach, and those are basically the chapters of the book. Okay. And so I want to talk briefly about this idea of box theory, because again, the whole idea is to be able to make sense of what's going on today and then apply that to the bigger picture and the zone level to get this 2 out of 3, at least 2 out of 3 in our favor, ideally 3 out of 3 in our favor, so that we know we can quantify a pretty strong edge. Okay, so boxes are it's a tool, it's a strategy. It's something that I developed on my own after a while to really see more clearly the flow, the natural ebb and flow of the market. And I'd done fine before I developed boxes, but it just, made it so much easier to make sense of the story of the day when I applied these boxes. And then I started teaching them a little bit to some people one-on-one, and I realized it wasn't just me. This was really helping people. I've applied this to teaching, everyone. And basically what these boxes do is they simplify the trading day. So, excuse me, I think of it like this. You don't typically, Liz Lemon there does, but you don't typically shove a whole pizza into your mouth, right? You cut it into bite-sized pieces, right, or smaller pieces. And again, it's a lot more effective, and it's a lot less messy, and it just helps. It's just a better way to eat a pizza, right? And it's the same thing in trading. If you're trying to make sense of the entire day, it's a little bit more difficult than if you can break it into its individual or smaller components, right? And so, think about it like here. If you look at these three images here, you can see this is a big lake. I think that's in Minnesota. Basically, that's our big picture. That's the market as a whole. Okay, what we want to do, rather than trying to make sense of that whole frozen lake, let's break it down into individual rinks. It makes it a lot easier. It's kind of our new playing field, okay? Once we've identified a smaller playing field, it's a lot easier to make sense of, okay? Then we can make our trading decisions at ground level. We can make sense of, when it makes sense to get in, where it makes sense to get in, how we want to manage our trades. It just keeps it a lot simpler. I always try to think about this idea. I call it win the box. It just means make the best possible decision we can within each box, okay? Sometimes that's not to take any trade or not to do anything and wait for more information. In fact, a lot of times that's what it is. Other times it's, where is the best place to get in? Where, do we want to fade this box? Do we want to go with this box? How much risk are we willing to take? What's the quality of the opportunity? And that's all stuff that we talk about. But again, the idea here with these boxes is it just helps you make better, easier sense of the day. Again, it's the market's always giving you clues. It's always telling you a story if you know how to read it. And these boxes really help you understand that. If we can, we can tell if buyers are more in control or if sellers are in control. There's kind of a box signature for that, okay? We can tell if we're in more of a trend day or if we're more in a two-sided choppy day, okay? There's a box signature for that. We can tell if the market's trying to reverse or if it's just probing into an area. We can see these with these boxes. And so here's a quick example, and I want to get into the idea of show some examples of the 2 out of 3 here in a minute. But here's a quick example. This would be, in this case we have buying boxes that are what I call stacking, okay? It shows us it's a one-sided market. It's a trend day up. And as soon as you see that first box start to stack, that's our assumption until proven otherwise, okay? It means that that buyers are in control until conditions change, until there's a change in our box scenario, okay? It means that we want to be on the long side, ideally. We typically want to be willing to take, be more aggressive versus less aggressive on our entry type approach. We want to typically try to hold for a larger profit, okay? It's a trend day. The boxes are stacking. We don't really want to fight that. We want to go with that. We don't want to try to be a hero and pick off the high of the day, okay? There will be evidence when things are starting to reverse. Until that time, stay away from trying to be a hero and selling it in an environment like that. Same thing here in the opposite direction. If we're stacking selling boxes, okay, it means it's a one-sided market. Sellers are in control. It's a trend day until proven otherwise. It means we want to be a seller until conditions change. Probably be more aggressive on our entry. Plan to hold for a larger move as opposed to when the market's more two-sided, where we want to think more point to point. Okay, again, don't want to try to be a hero and pick off the low. There will be evidence when there'll be box evidence when it's starting to turn. Okay, so with that said, here's another example. This is an example where we've kind of got a two-sided market. There's boxes are going back and forth, red, green, red, green. There's no stacking. It's showing us that there's not a trend. It's more of a consolidation type of a day. It means we either need to stand aside or we need to be more thinking of fading or reversing with the market. In other words, buying lows, selling highs. We want to be a lot more conservative, more risk averse, take less aggressive entries. We want to think point to point and not go for huge moves. We want to think, one-to-one kind of risk to reward type ratios when we have a day like this. In other words, if we can read what type of day we've got, we can really adjust our whole approach in terms of what types of trades we want to get into, how we want to manage those trades, how aggressive or how conservative we want to be. It makes a big difference. Here's another example where we have stacking buying boxes. Then you can start to see sellers come in. We get a selling box below a buying box. It shows us that the market is trying to reverse. It becomes a two-sided market. Then we see selling boxes start to stack. Now it's a one-sided selling market. So again, we talk about all this in the education, but it's just the idea of breaking down, instead of looking at this big day all in one, we're trying to break down the day into smaller components and kind of, you know, minimize the size of the auction that we're seeing each day so that we can make sense, a better sense of what's going on. Okay, so, you know, if you think about that, just as a quick review here, we've talked about this idea of 2 out of 3, right? If, you know, one of the 3 is a big picture bias. Like I said, we'd rather be trading with the big picture bias than against it. We would certainly be willing to trade against it. It just requires a little bit more proof. Okay, we also have a second level of evidence called the zone evidence, which is, again, a little bit different take on support and resistance. Okay, so we want to see how the market's reacting within these zones. That's giving us evidence. Then we also have this evidence based on how the market is behaving today, using aggression bars and boxes and putting that all together. So we can tell on each of these levels which side is more in control. We can tell, or if there's no control, we can tell if it's more neutral. We can tell when we look at each of these levels, you know, the degree to which the buyers or the sellers are in control on a given day. Okay, so, you know, each of these are, and this is a really key point, each of these pieces of evidence in isolation is a good piece of evidence. Okay, just like, you know, you may have other indicators that you look at, and in isolation they're probably good indicators. There's no magic indicator there. You know, it's the idea that if you try to trade something in isolation, however, or things that are too tightly related, you're going to find yourself in trouble. To be able to kind of repeat your edge, you have to think about the market in context and put these things in combination. That's the idea. We're looking at the market in from three different perspectives. The more that they line up, like I showed earlier with the, you know, unicycle versus bicycle versus a three-wheeler, you know, the more of those that are in alignment, the more stable we are, the safer we are. By no means are we ever going to be perfect. I'm trying to be very clear about that. I assuming most people don't think that, but anytime you hear someone saying 90% winners, I mean, that's just full of crap. It's not how it works. All you can do as a trader is try to make the best decision you can with the evidence you have, and try to continually put yourself in situations where the amount of risk you have to take is reasonable relative to the quality of the opportunity. And if you consistently, if you know how to judge that, first of all, and then you consistently put yourself in those situations, you don't win every single trade. You don't even make money every single day. That's not the point. The point is that you consistently do that. You're going to always be in the right situation. That's how we make money over the longer term. Okay, again, any given day, any given trade is a little bit random, but we can control over the course of days, weeks, months, when we consistently put ourselves in situations where we have an edge that we can quantify. We're going to put ourselves in a profitable situation. So I wanted to give a couple of examples, and I'll take some questions after that, of this idea. I did, you know, I've got a couple examples from Monday just because I did the slides on Monday. There's nothing magical about Monday. You know, every day you're seeing something like this. But this is an example from Monday on the Nasdaq, okay? If you look at this, what do we have? We have an area, first of all, our big picture bias is down. It's actually down with caution, but for the purpose of this, we'll call it down, okay? It's the same reasoning. And so on the big picture, we'd rather be short than long, okay? Doesn't mean we can't go against that, but on the big picture, we'd rather be short than long. Now, we've got an area of zone resistance above the market. We've got an area of zone support below the market, okay? So then, you know, that's telling us if we're below or we break below this zone, that's a bearish indication, and we would expect resistance as we test the low of this zone resistance on the high of the day. So that's an area of resistance where I have it circled there on the zone level, okay? Then we also have a selling box. Now, at the beginning of the day, we only had one selling box. We didn't know that these other selling boxes were soon to follow. But what we do know is that the high of a selling box should give us resistance. And then on the box level, it's a bearish indication. So if you kind of break down what we have at the very beginning of the day there on Monday, if you break it down with the 3 pieces of evidence, well, the big picture bias is down, means that all things equal, we would rather be short. That's a bearish piece of evidence. On the zone level, we're below the zone and actually testing right into what I call the zone resistance area right there. That's a bearish indication. What about on the box level, the aggression bar level? We have a selling box, okay? That's telling us all things equal on the box level, the market is bearish. There's 3 out of 3. It's telling us that the path of least resistance is to the downside. So can we find a spot to get short? This is using an example of a trade called a retracement trade, but toward the high of a selling box there, we're getting short. We're right at a zone resistance. We're right at box resistance. and we are trading with the big picture, which is down. That does not guarantee that the trade is going to work. I can show you examples where it doesn't work, okay? What it is telling you is that we have a very reasonable amount of risk. We would know we're wrong if the market starts to trade comfortably above that buying box and back inside of that zone, okay? Until that happens, we know that the path of least resistance is to the downside. So we can have a very minimal amount of risk, knowing that our percentage of I'll answer some questions here in a second. We know that our odds are in our favor, so that's a pretty good spot to get short. Now, what is our expectation when we get into a short at the high of the box? Our first expectation would be it should make its way down to the low of the box, which it did here. Okay, kind of exhaled, got down to the low of the box. At that point, you have a choice. You can take profit there, or you can hold on for a bigger move, but you're probably going to protect yourself at that point no matter what, okay? So it's kind of think about the first, exhale of the market is it pushes it down to the low of the box. That means it's basically done its job. From there, we have a choice to go for a bigger move and wait for another, exhale of the market, or we could just take profits there. Sometimes some people like to scale out. I typically don't like to scale out, but, that's something that you can think about. That's the idea behind it, okay? So that's, the idea there. We get down toward the low here at the support. Certainly on the box level, it's very bearish at this time. We've got 3 stacking selling boxes, okay? However, if you're going to sell it down here, you're risking that you're selling it right into an area of support. So, we have to be a little bit flexible as we go through a day, and that's why during webinars and when we're doing live sessions with the members, I'm always doing this breakdown. You could literally do it minute by minute. I don't do it that often, but we'll say, hey, at 10:12, the status of the ES is this, and we say, okay, what's the, do we have 2 out of 3 in either direction? What would be a good decision to make at this time? It's a methodology. It's not always going to be perfect, but it's a methodology that you can follow that tells you, hey, it's very, objective. It's very matter of fact. You can keep your wits about you. The market might feel like it's, going up, 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 but then you realize, okay, the evidence is telling me I better be careful here, and so forth. So it's just a repeatable process, and that's really what everything comes down to in life in terms of having a success, is having a process that you can follow that's repeatable. You could get into a trade at any time, or anyone can show you a chart from any time where, hey, if you would have sold here, it would have worked out great. If you would have bought here, it would have worked out great. That doesn't do you any good. That's not repeatable. That's luck. What you need to be successful in trading is a repeatable process. Okay, it doesn't have to be this one, but you better have a repeatable process that you can trust, that you can lean on, that you're not dependent on your emotions, you're not dependent on your gut feeling. You're saying, okay, this is what the evidence is telling me. I have, if I'm thinking about a short or a long or whatever, I've got 1 out of 3 pieces of evidence, or I've got 2, or I've got 3. Again, it doesn't mean it's always going to work, but it is a repeatable process that you can depend on and trust. Here's another example again from Monday in crude. We have a situation where the day before we started in this containment zone, okay, and we broke above this pink zone down here, okay? That's a bullish indication, okay? Our big picture bias going into the day is up, okay? And then we have a situation where shortly after the day begins, we have a buying box that's formed, okay? So whether we want to use what we call a retracement trade or a breakout trade above that box, it's telling us if we break it down piece by piece, what's the big picture bias? It's up. Well, that means all things equal, we'd rather be long. It's a bullish indication. On the zone level, we broke above this zone in the overnight, okay? That's a bullish indication. What about what's going on right now during the day? Well, we have a buying box that formed. That's a bullish indication. It's telling us 3 out of 3. It's pointing toward we'd rather be on the long side than the short side. And you can see that we make our way higher. It's not until we start to see some selling develop that the market goes a little bit more two-sided, and that conditions change. Then we have to reassess what's going on, moment by moment. We have to be mentally flexible, mentally malleable to be able to look at a given situation that maybe 10 minutes ago was telling you one thing. We have to be able to adjust. And again, that's the importance of following a defined process. You can always say, okay, what is the evidence telling me right now? How do I best handle this? Because that's, at the end of the day, we get paid as traders for being good decision makers, right? We don't get paid for being, button pushers, system followers, whatever the case may be. We get paid by making good decisions, okay? And if you have a process for making decisions, you have a lot better chance of being successful and being able to follow that process. So hopefully this makes sense. I mean, we could look at a million more examples. I think I just put 2 on here. You know, if you like these ideas, and I'll answer some questions here in a second, but if you like these ideas and you're kind of sick, like I said, I did this for the first 7, 8 years of my career, just kind of chasing this magic claim, time after time, this next indicator, this next method, this next trade room. You know, if you're kind of sick of that and you'd rather just kind of get back to no amazing promises, but the idea that there is a way to make sense of the market so that you can more consistently make better decisions and you can more consistently get yourself in situations where the risk you're taking is reasonable compared to the opportunity that exists, then I would invite you to come along. I think it's easier. This happened to me. It's easier to have a guide. I wouldn't go down a raging river without a guide, and the markets are similar. And so I tried to do it on my own or with bad advice for many years. It wasn't until I got a mentor and became a good friend that things turned. And I think there's also kind of a back and forth. I gain a lot from working with people as well. So I'll take some questions, but I do want to point out that I'm not trying to hard sell anyone, but if you are interested in this, I do have, or I'm willing to offer a very, very good discount, quite a good discount actually. And so all you need to do is just send me an email at info@daytradethemarkets.com. I'd love if you told me a little bit about yourself or what you're looking for, questions that you might have, and I can write you back with answers to those questions, and I can also tell you about the deal that I'm offering. Again, it's info@daytradethemarkets, and I'm not gonna, like I said, I'm not gonna hard sell you, but I will tell you that it's a lot of great feedback from the people that I work with. Real quickly, I mean, it's not for you if you're looking for the magic bullet, if that's where you are in your trading, or you're still of the belief that there is this perfect system, you just have to find it. If that's where you are, and I don't judge, and that's where we all go through this process as traders, I would invite you, if that's where you are, to move through that as quickly as you can. But if you're a serious trader and I'm not saying you have to be a great trader, but if you're serious about doing this and you're willing to learn and you're willing to try a little bit of a new approach and put in the time, and I can say with great confidence that you're going to really enjoy this. If you're looking for black and white perfection, holy grail, this is not for you. That's okay. This is not for everyone. That's fine. But I just, I'll stop selling here. But again, if you're interested in a discount, very good discount, just shoot me an email, info@daytradethemarkets.com. Let's see here. The couple questions here. Let me just go up and look at some of these. Lou is asking, can't you see this by watching price? Oh, like I was saying before, this is when I was talking about aggression. We want to get inside of price, right? We want to get inside. The price told us what happened. We want to ideally see what's happening. We want to see aggression is what leads price. So if we can actually see the aggression, we have a little bit of an advantage over just looking at a price chart. Okay, so hopefully that makes sense. Steve's asking what time frame. I'm usually, for an ES chart, I usually use a 1-minute chart. For crude or gold or a little bit more fast-moving markets, I typically use a 2-minute chart. That's my style. You don't have to use that time frame. You can take it, some people use a 30-second chart. They really like to see things popping, and some people use a little bit longer term chart. It really is dependent on your personal style, but that's me. Let's see. Tom says you could have up boxes, not just 2 big ones. Very subjective. Well, not really. The boxes are all based on objective rules. So there is a rule when a box forms, and when it doesn't meet those rules, the box doesn't form. So now you don't know what's coming in the future, of course, but you can certainly know when a box forms, what it's telling us, and then how the market reacts to that box. Let's say we have a buying box. Does the market then get above that buying box? Well, that shows us that the buyers are continuing to be in control. Do we get another box on top of that? That would show us stacking buying boxes. That would tell us that we would expect, again, expectation doesn't mean it's always going to come true, but you start to get 2 buying boxes stacking on each other, or 3 or whatever, we would expect that until proven otherwise, this market wants to move higher. It's showing us the signs that it wants to have a trend day. And that's our expectation until that would change. So, you know, I think it's actually very objective. Let's see. What determines your zones? A lot of different factors. I like to use, you know, profiling mainly, volume profiling, and I just been doing that for years and years and years. And so I post that on our, you don't have to know a lick about that. I post that on our, what we call the Daily Market Assistant each day, so that you're able to see, you know, before the day starts, those are all laid out and listed. So nothing changes with them. Those are all listed, and they, I have to say they're pretty good. So that's it's based on that. Let's see. Rose is asking 60-minute or day chart. I think a 60-minute or a day chart is certainly a day chart, but I think that's a little, if you're, this is a day trading thing. It's not really, you can use it to a degree for swing trading, but it's mainly for day traders. So if you're looking for a daily chart or 60-minute, then that's going to be too long of a time frame to for this style of day trading. Let's see. Question: how do you identify aggression bars? It's an algorithm. It's a formula. It's looking at several different factors. It's looking at order flow, volume, range. Let's see, volume. I said that. A concept called velocity. So a lot of different factors, and we're trying to make sense of what's the norm in the market, and then we can see when either buyers or sellers are stepping in to a higher degree, and we can see if that's happening on a moderate level, strong level, or a extreme level. Tyler's saying, are you going to trade Bitcoin futures? I am very excited about that possibility. I can't say with 100% certainty that I'm going to, but I can. I'm certainly going to start looking at them. I'll probably give it a few weeks of kind of analyzing it, but I would say that I'm 90% that's going to be part of the offering that we're going to be focused on each day. So yeah. You is asking, so basically we need to wait until the market gives us a very profitable situation probability-wise. Well, yeah, absolutely. I mean, you know, you have to have, like I said, you have to have a repeatable process, okay? And that, whether you like this idea that I'm proposing or not, whatever you're doing, you have to have a repeatable process, okay? Now, most of us, the big mistake that I see, most of us try to make a repeatable process based on a trade setup, okay? Now, I would say that's destined for failure in most cases. Maybe not all, but in most cases. The repeatable process you need is to be able to read the context of the market, okay? Then, in other words, if we have a very strong possibility that the market wants to move higher, the trade entry is not quite as important. We don't have to be exacting. You could have the greatest trade entry in the world. If you get the direction wrong, it's not going to work out. You could have the worst trade entry in the world, and if you get the direction right, it's going to work out. So it's about the context first. And if we can, you know, we're never going to be 90%, okay? That's not going to happen. But if you can quantify when you're certainly much better than a coin flip, you've got an edge, right? And then what you just simply ask yourself when we talk about reverse engineering trade entries is how much risk do you really need to put? In other words, you essentially think about it like a scientist in a repeatable process, right? You have a situation where you feel that there's pretty good opportunity to the long side, let's say. The next question is, okay, how much risk do I have to put to test this theory? Okay, how much risk do I have to put on the line? And we talk about how you can define the amount of risk you need based on the structure of the market. Okay, now with that said, when you have situations where that amount of risk is reasonable compared to the opportunity at hand, you have an edge. Okay, you can quantify when you have a bigger edge versus more of a borderline edge, but that is our job as traders. That's the game we're playing. That's the business we're in, is quantifying opportunity, quantifying edge, determining when those, you know, add up to your favor. That's the whole deal. Let's see. Can you get on the Forex market? You can. I tend to not focus myself on the Forex market, but you can certainly do it. I'm pretty much a futures guy only, but you can certainly do it. Jacob says determining where to take profits is more important than the entry. I tend to agree with you on that. Like I said, context is more important than the entry exactly as well. That's why I don't focus on trade setups. I focus on context. And then you use context as well to make sense of the exit. Like I said, so the way I think about an exit, we talk about this on the box level, okay, Jacob, is our expectation would be that the opposite side of the box is kind of our first target. It's our first decision point, if you will, okay? And that's where we make our first choice. If you're more of a quick in and out type trader, you're going to take profits right there. There are certain times, certain market contexts where it makes sense to go for more of that, or certainly you can justify going for more of that, okay, than more than that first target, that first, decision point, okay? And that's, again, using context, you can tell, or you can have a pretty good idea when, let's say, the buyers are in control, or we're expecting more continuation higher, versus when we're more of a two-sided market, you need to get it in and out more quickly. So I completely agree with you, Jacob, that taking profit is certainly more important than the entry, or knowing how to do that. But both entry and exit always come back to context. If you try to do the exact same thing with every single trade, in my opinion, you're in a little bit of trouble. I mean, I always use sports analogy when I'm teaching sports analogies. If you think about a golf shot, right? Let's say you have a 100-yard golf shot. You could theoretically, if you're a robot, you would just hit a pitching wedge every time 100 yards and just not think about it. But in real life, if you're really playing golf, the lie comes into effect. Is there any danger in front or behind the green? What's the wind? What is the conditions? What's the temperature? What is the situation in your match? There's so many different variables that come into play that if you try to treat every situation the same, you're going to be in trouble. And it's the same in trading. There are no two situations that are exactly the same. The context of the market is always shifting. We have to have a kind of a continuum, or a way of making sense of those different variables, so that we know when it makes sense to go for a bigger profit versus when it makes sense to scale out quickly. We know when it makes sense to be more aggressive on entry versus less aggressive, and it's always about that context. You'll hear me say that a million times if you work with me. Yeah, Jacob, it does depend on your trading plan and what kind of trader you are. Absolutely. That's why I say that if you are a more conservative trader, we have the idea of what our first expectation would be on any trade. It's typically based on the other side of a box, right? Now there are, like I said, times, and I would encourage you over time as you get better at this, to really look at the context and say, hey, think about it in terms of your expected value, not what necessarily would happen on one trade, but there are times where it makes sense to give a trade a little bit more room. There are times, and try to go for a bigger move. There are times where it doesn't, and you need to scale out pretty quickly. And that's again comes down to context. Avi is asking, by the time the box forms, isn't the move over? Do you enter as the box is forming, or do you wait until you have two boxes? Well, there are a few different options. We do have, a breakout type of a trade, or a more aggressive trade. Again, it comes down to context, right? So if you can identify that the big picture bias is up and we're above a zone, or we're breaking from a zone, by all means, you've got 2 out of 3, and you can just jump on an aggression bar and try to go for it. If you also, though, wait for a box to form, one of the benefits of waiting for a box to form is typically when a box forms, you get a pullback to between 50 and 100% of the box low. You know that in that area is a pretty safe place to get long, for example. Your stop can be a little bit below the low of the box. You've got a pretty low, you've got better structure to make sense of where your risk needs to be applied and what your expectation would be on the trade. But by all means, you can always just jump on board and get on board a trade and just go for it when the context says it. But by waiting for boxes to form, I think that you have a little bit better structure to work with. Let's see. Do you use your aggression bars to enter when a box is broken out of? Oh, absolutely. You can certainly do that. That's what we call a breakout trade. So yeah, and again, I have 5 rules that I like to use for breakout trades, and it depends on, again, the context, surprisingly, right? So yeah, it's all about, so I mean, this is not something that's for the trader that just wants to put their brain aside and, click the button and think they're going to be rich by next Tuesday. That's not how it works. I mean, I know that that's what a lot of traders want, and a lot of people will try to sell that to them. That's not my thing. That's not how trading works. And but if you are serious about trading and you really want to try to make sense of what you're seeing and get yourself in good situations, then I think this is something that you should explore. So hopefully that makes sense. Looks like I'm running out of time here. We're on about an hour. I don't think I see any other questions. But I would advise you, if you have other questions, by all means, just go ahead and shoot me an email, info@daytradethemarkets. And if there's anyone that is interested in a really good deal, I would be more than happy to offer that. But I just need you to send me an email, and then we will. And again, like I said, you can ask me any questions with that. I'd love it if you told me a little bit about yourself, your trading history, whatever you want to say. Then I can respond to that as well. I am someone who is not. I really value working with the people that I work with. I'm not trying to be everything to everybody, but there is a certain type of trader, and I've tried to explain that type of trader who it tends to go very, very, very well. So hopefully, if that resonates with you, then please shoot me an email, and I'd love to work with you. Otherwise, I really appreciate you watching the session today, and I would love to hear from you. So I think that's it for the questions. I really appreciate all the good questions. I appreciate your time, and I really want to thank NinjaTrader one more time. And I suppose that's it for now. Ryan, if you want to take it over.
Yeah, this is Ryan hopping back on from NinjaTrader, and I'd like to give a special thank you to Justin Weinraub of Day Trade the Markets today for a great presentation. And the NinjaTrader ecosystem is pleased to sponsor our weekly vendor events as a value-added service for all of our clients. So if you found value in this event or in any of the other events, we would hope that you would attend them on a regular basis. And we'd like to remind everybody in the room today that the information provided in this presentation was that of Day Trade the Markets and not that of the NinjaTrader Group. All information presented was for educational purposes and should not be construed as trading advice. If you are curious about more training opportunities with NinjaTrader platform, you can take a look at our schedule here. We do have live platform training throughout the week. Again, we appreciate the time that you spend with us in our webinars. We hope you enjoy the rest of your day and hope to see you in our future webinars. Happy trading from all of us here at NinjaTrader.